Are you tired of using the same old market strategies, higher highs, higher lows, and still missing out on profits? Well, there's an advanced market structure that can change everything. Imagine entering high probability, profitable trades almost every single time. This is the game changer you've been looking for. It's the secret weapon that top traders use to consistently win. And today, I'm going to break it all down for you. Stay tuned, because by the end of this video, you'll know exactly how to take your trading to the next level. Guys, there are two structures in the market. One is the retailer's market structure, and the other is the advanced market structure. The retailer's market structure is what you're taught from the beginning, that the market makes higher highs and higher lows, creating higher highs, moving upwards, pulling back, and then continuing the trend. If it breaks down, then the trend shifts, but this never really happens in the market. You can never make a profit in the long run by following this structure. Why? Because the market never operates so simply. The market doesn't just create a higher high, then a higher low, and then move upwards. Instead, the market often breaks the high and then continues downwards. Even after breaking the high, the market continues in a downtrend. This is the advanced market structure, the top tier SMC, the ICT market structure. So let's start the video on the advanced market structure. In the advanced market structure, there are three components. 1. Long-term highs and long-term lows, which we call long-term swings. 2. Intermediate-term highs and intermediate-term lows, which we call intermediate-term swings. 3. Short-term highs and short-term lows, which we call short-term swings. Among all of these, the most important is the intermediate-term swings. Let's take a look at the long-term swings. Here we have the market, and there is a PD array from a high time frame, some order block, breaker block, mitigation block, or rejection block. From this PD array, the market caught the sellers and shifted its real market structure. What happens in the market is that the real break occurs, and the market shifts into a downtrend. This high, which reacted from the high time frame PD array, causes the real market structure shift in the market. This will be our long-term high. If you reverse this entire scenario, then you get the long-term low. I hope you understood that the long-term high gives us a narrative of what the market is likely to do next and what it is communicating. When the market reverses from a high time frame PDA and shifts the market structure, it indicates that the market is shifting from an uptrend to a downtrend. In simpler terms, smart money reversal is happening. Next, we have intermediate-term swings, one of the most important swings in the market structure. There are two types. 1. Classic intermediate-term swings. 2. Rebalance intermediate-term swings. First, let's look at the classic intermediate-term swings. Here we have the market, which made a swing here, another swing here, and another swing high here. Now we have 3 swing highs. What is an intermediate-term high? It's a swing high that has a swing high on both its left side and its right side. That will be our intermediate-term high. And the 2 smaller swing highs on either side are called short-term swing highs. But we will study short-term swing highs later to understand their role in the market. This is our classic intermediate swing, which is not that important. The more important type is the rebalance intermediate swing. Let's first understand what swings are. Here we have the market, and there was a fair value gap here. I hope you're familiar with fair value gaps. If not, don't worry. I've already made a detailed video on fair value gaps, and you can find it linked in the icon above. If someone asks you what the most important thing in the market is, what would you say? The most important things in the market are 2, liquidity and fair value gaps. You might not understand this right now, but after 1, 2, or 5 years, you'll realize that the market runs on only 2 things, liquidity and balance. There was a fair value gap here. The market made a swing high, reversed, tapped into this fair value gap, and then continued. That swing high that tapped into the fair value gap and gave a reaction in the market is our intermediate term high. Intermediate term swings give us a framework of what the market is going to do. They tell us that this is what is happening in the market and this setup is forming. This is where you need to make an entry. It gives us a complete framework. Now, let's talk about short-term swings. Here's the market. Where is liquidity located in the market? There's liquidity above this high and liquidity below this low. Those swing highs and swing lows that have liquidity above or below them are called swing term highs and swing term lows. Okay, if you don't know which highs and lows have liquidity resting above or below them, what liquidity is, how liquidity works, how the market runs above liquidity, how run-on liquidity happens, how draw liquidity happens, how liquid sweep occurs, and what the types of liquidity are. I've made an advanced video on all these topics. You can find the link to that video in the I option above. You can tap on it and watch. Another type of short-term swings I mentioned before in this video are those swings that occur on the left and right of the intermediate swings, and they are also short-term swings. Guys, the market was in an uptrend. Here there was a 4-hour breaker block, which I marked. We will wait for the market to reach that point. Now, notice something. Our breaker block is above, but the market is already falling. The market is creating inducement here. This high has not taken out the previous high, and notice that no high is violating another high here. This means that liquidity is being engineered here. Sellers are being led to believe that the market is going to fall, and they are being encouraged to sell quickly. After introducing all the sellers, the market will go up and hit their stop losses. Look what happened here. The market fell with displacement, then fell sharply, breaking this low and then this low. All the retailers thought that the market structure had shifted, believing the market had undergone a choke, change of character. Now all the sellers have entered the market, expecting a downtrend. But what will the market do? The market will take their stop losses, hit our PD array, and then rise again after clearing out the stop losses of all the sellers. Now we wait for the market to break this point. This is our real choke, change of character. The market has made the choke. Now the real smart money reversal will occur because this is the real choke after consuming the liquidity of the inducement. When the intermediate swing low is broken, that's when the choke happens. You can see this swing low and this swing low. This is the intermediate swing low. When it's broken, the choke happens in the market. Now we will wait for another intermediate term high to form. When will the intermediate term high form? When the market returns to the fair value gap. Here, we had a fair value gap. You can see this was the fair value gap. The market came into it, and this became the intermediate term high. But still, we won't take an entry here directly. We will wait for a short-term high to form and its liquidity to be swept. This became our short-term high. Now, what was this? This was the intermediate term high. And what was this? The long-term high, because it hit the PD array, shifted the market structure of the higher time frame, and gave us a narrative that the market will go for selling. After that, this was our intermediate term high. Why? Because it hit the fair value gap, and after that, the short-term high was formed. What comes after the intermediate term high? The short-term high. Now, what will we do with the short-term high? The short-term high is a liquidity point for us. There's liquidity above this point. I'll also write it here. There is liquidity above this. The market will come here, sweep the liquidity, but won't break the intermediate term high. And from there, we will create our selling position. We will place our SL stop loss above the intermediate high and then look back to decide our target. One target could be here, another could be here, and another one here. We will aim for the lower target. If these high breaks, or if the intermediate term high breaks, it means our idea was wrong. This way, our stop loss will also be small and we'll place it above this intermediate term high. If this intermediate term high breaks, we are wrong and our idea in the market is incorrect. We will take the SL there. This way, in this market structure, our SL becomes smaller. Now, we wait for the market to tap our entry. Boom, our entry got tapped. The short-term high is gone, the intermediate high wasn't violated, and the long-term high is still in place. We entered here, and this is where the smart money banks entered, and they all went short here. Our TP, take profit, was hit here. That's it. Lower high, lower low, lower high, lower low. Just keep finding them and taking entries. The market structure should be the one that also gives you entries. This is the real market structure. Now think like a retailer. Here we have a lower low, and this is the lower high. The lower high broke the structure, and the structure got broken here. The market went up, and it did a choke, change of character here. Now the retailer thinks of buying here. But the real market structure waits for this high to break. Once the high breaks, the banks entered and the market fell from there. Making videos like this takes a lot of effort. Writing the script, creating animations, doing voiceovers, editing, creating thumbnails, etc. If you found this helpful, don't forget to like, subscribe, and share with your trading friends. Drop any questions or future topic suggestions in the comments below. Thanks for watching and see you in the next one. Goodbye.